and welcome to Pioneering Pensions. For you who don't know me, my name is Stefan Lundberg and I have a passion for pensions. We have invited Richard Fullmer, who is known as Mr. Taunting. And he wrote the famous CFA paper on tontines. And he has a background from the insurance sector, and he's also working in the financial sector. And he's now started his company called Nuovalo Ltd, where he's working on solving these problems in a simple and accessible way. So Richard, I wish you welcome here to Pioneering Pensions.
Thank you, Stefan. Great to be here with you.
The same. And for all of you in the audience, you're very welcome. And we do have the chat. So when you have questions during our conversation, please type them into the chat. First half an hour, Richard and I will discuss. And after that, you can ask any question you want to Richard on how to solve the problem of offering a lifelong income. So Richard, before we kick off, I think it's a good idea. Can you explain to us what a tontine is? And I think the way you look at it, because most people, when they hear the word tontine, they think about the old-fashioned tontine, or they think about Squid Game, which is an example of, you know, the last person standing gets it all. So can you just give us sort of the helicopter overview?
Yeah, sure. Yeah, good to start with the Squid Game, I guess. It's like something we're not talking about. So, you know, that's a type of tontine scheme. It's really favored by fictional novelists and scriptwriters because the last survivor takes all narrative and introduces a great sense of drama, right? So it's a grand lottery of sorts with an unsavory incentive to knock off your fellow lottery ticket buyers. And it makes for compelling scripts, but not really an arrangement that I would want for anyone's pension. Now, unfortunately, that's what many people at least think about when they think of the word taunting, as you say, right? So let's kind of step back from that for a moment, kind of examine what I would call the taunting principle, right? So stop thinking of it really as a product, but more as a principle. So it's really about longevity risk sharing. And it doesn't have to look anything like the Squid Games or the tauntines of the past. So, you know, the concept goes back to the 1600s. We could spend a whole episode discussing its fascinating history, both the good and the bad, but I suppose you prefer to talk about the present and the future. So let's do that. Now, I'd have to say that tauntines of centuries past look rather different than the modern tauntines that are envisioned for today, but the longevity risk sharing principle is similar, right? And that's the important thing here, the power of longevity risk sharing. What is a tontine, or whatever you might want to call it? Now, it's basically my definition, right? I say it's like a longevity risk pooling arrangement in which investors, often irrevocably, but not necessarily, they agree to pool their money or something of value. It doesn't have to be money. It could be a bottle of whiskey or whatever, right? Something of value. They receive payouts from it while they're living, and then they forfeit their accounts upon death to the surviving members. So the other members of the scheme are basically your beneficiary, right? And there's two sources of return in this arrangement. One is there can be investment income, like normal investment income in a normal and defined contribution account, and then what is called like survivor credits or longevity credits from the balances of members who have died. And those are similar to mortality credits in like an insured annuity. Now, the thing about this, of course, is that the longer people live, the greater their cumulative payouts. And that's beneficial because the longer you live, the more money you need, right? And that's really it. It's like a regular investment, but with a mutual agreement to share your longevity risk. So can it be added to a DC plan? Of course it can. I just note also, just to dispel kind of what people's mind, what they think about when they think of tauntines. I said nothing here about what the investment has to be, or even that the participants have to choose the same investment, right? And I also said nothing about the payouts have to be escalating over time, or that there's a last survivor, or that it's a closed pool, could be an open pool. Or I didn't say anything that the participants must all get the same kind of payout, right? It's sharing, that's all it is. So
Thank
this
you, Rich.
sort of pooling basically offers lifetime income without a guarantee of exactly how much that income is going to be.
Thank you, Richard. And Keith Ambach here, our previous guest, he also gave this topic quite a lot of thoughts. And he had a question for you, actually. But instead of me telling that question, let's roll the tape and see what he had to say.
How do you make it work in the real world? In other words, how do you actually create an offering that, you know, that survives and lives in the real world? And what's encouraging to me now is that, you know, you've got the Australian example. Q Super has created one of these pools. In Canada, there's been a pool created through the mutual fund sector under securities law rather than pension law. And so I think, you know, the interesting question for Richard is, what's the best way to actually not only design it theoretically, but to practically, you know, bring it out into the marketplace so it gets used by a lot of people to their advantage?
That is the ultimate question, isn't it? So, you know, in some ways, as Keith mentioned, right, we don't really have to speculate on this because we have examples of it happening today, right? He mentioned Q Super. He mentioned the mutual fund in Canada by Purpose Investments. So there are companies that are doing this. Now, I would say, you know, those are kind of rolled out as packaged products. They offer essentially like a taunting going on inside of them. The buyers can receive lifetime income. It's going to vary with the investment and mortality experience of the pool. The product provider guarantees nothing, right? But rather only manages the investments and the reallocation of participant balances when someone dies. It doesn't necessarily have to be that package, right? And I think we're going to talk some more about other options. But the idea is that here, I think, you know, Mike Saban and I wrote a paper a few years ago showing how longevity risk can be operated using separate accounts, as is typical of the DC system, or even brokerage accounts. So it doesn't necessarily have to be that, oh, I'm going to buy one mutual fund that gives me some kind of risk sharing going on inside of it. It could be that, oh, I'm just investing in a DC plan. I can invest in whatever options are available to me within the DC plan, and I'm opting into a risk sharing arrangement. So there's a number of things that have to happen, I think, in order for us to provide this kind of service. One would be, you know, being able to help people understand what they're getting, right? What their choices are, making good choices. So there's going to be a significant amount of help for participants to know whether or not they should opt into this, and if so, how much money they should put into it, that kind of thing. And that's typical today, right? We provide those kind of tools for people today with their current investments available in the plan. But they would be able to create their own, you know, perhaps their own payout elections if multiple elections are given to them. As I say, it doesn't necessarily have to be like one product where everyone gets the same investment and everyone gets the same payout.
So Richard, you're saying the secret sauce is that you can separate the biometric risk from the investment risk.
Yeah, that's right. I think the way to do that to help people is to show these like broken out separately, right? So you think of an account and I have my DC account, right? I can see what my balance is, say at the start of the year. I can see what my investment returns have been. I can see were there any contributions or withdrawals from the plan. So if we're talking about like the post-retirement phase, it's probably withdrawals from the plan. What I would also want to show, I think, is to say, oh, not only do you get those things, but you also get, you know, this period, you got some longevity credits, right? Because you survived and others didn't. So you got an extra amount of money that came into the plan. And just to be able to make it very transparently accountable, right? So it's just like, oh, of course I have investment returns. I also have another source of return from these longevity credits. I can see exactly how much it is. And then people will start to think about this kind of arrangement in a different way.
Thank you, Richard. And how should we think about this then? Because from a biometric perspective, we have all, should you think of it like one big pool of people, or do you think of it like smaller pools, which are perhaps on vintage, depending on, you know, which year you're born, or 5-year cohorts? What's your sort of take on this?
Sure, that's a good question. So I think it can be done either way. So most of the examples that we see today are kind of the latter, I'd say, where it's like a closed-end pool, and it may not be marketed this way, but that's how it operates underneath, right? So something like, oh, the provider is creating a product, and they're going to group everyone at a certain age and maybe a certain gender, right? So if you're a male 65, you go into the group that's male age 65. Females who are 68 go into a separate pool, right? So you have multiple pools, and there it's more of a kind of a horse race, right? Am I going to outlive the 65-year-old men, right? Or whatever pool I'm in. And that's, I think, somewhat understandable for people. It's like, oh, I'm going to be in the same pool as people that are the same age. So, you know, it just seems kind of simple that, you know, that we all have kind of the same risk of dying, and I'm going to accept that. But I mean, everything's a trade-off, right? Every decision you can make is a trade-off as a provider of these things. And one of the issues, I think, with those is that the pool becomes smaller and smaller over time as people die away, right? So at some point, there's going to be one person left, right? And, you know, the great thing about pooling the risk is that it diversifies it, right? But as the pool gets smaller and smaller over time, the diversification gets less and less over time. And that's not something that we should be striving for. So another way to do it would be have an open-end pool where everybody, regardless of their age or gender, can be in the same pool, and the pool could go on forever, right? It's not like you have to be everyone born in a certain year. It can keep going on, and then the pool would never dwindle. It could continue growing over time, and therefore the longevity risk diversification stays robust.
How do you make sure that it's a fair pool then? Because you could argue that if you have a 100-year-old in that pool and a 67-year-old person, how do you make sure that sort of the mortality gains are distributed fairly?
Yeah, that's a really great question. So there's some papers on this. I've written a couple, and others have as well. I guess I would frame it this way. I think about, like, say you're flipping a coin and you want it to be a fair outcome, right? So I'm going to put in $1, and if I call heads and it is heads, how much money should I get from that? Well, that's kind of easy to calculate, right? It would be $1. So, because half the time I'm going to win, half the time I'm going to lose, and over time, I flip it enough, right? My expected outcome is going to be 0, right? So we call that a fair game. You can do the same thing with, say, a roulette wheel, right? Say it has 36 slots. What would be the fair payoff? Now, in a casino, you don't get a fair payoff, right? Because the house takes a cut. But if the game is fair, there is no house taking any cut, right? So you can easily compute what the payoff should be. Same thing with rolling dice, right? I'm going to guess what the number on 2 dice is. I can easily determine what the payoff of that should be. And it's really the same principle going on here, right? So if I'm 100 years old, my risk of dying is much higher than if I'm 60, right? So I can calculate the odds, basically, that I'm going to survive another year or another month or whatever period we're using for a man and a woman of different ages, and possibly even more factors, right? Like social, economic, what was my occupation? Was I a coal miner? That kind of thing, right? And compute the odds, basically, and then say, okay, everyone gets the fair payoffs, right? So if I survive the period, I'm going to receive a portion of all the money from people who died in proportion to what was my risk. How much money do I have into the scheme, and what was my odds of survival?
And then you can argue the other side in saying, well, these are just odds, but realizations might be different. So my question would be, how fair do you think it has to be? How exact should the fairness be?
Yeah, that's a good question. So, so people who like math, right? Actuaries and others try to find like the absolutely perfect formula for 100% actuarial fairness, right? And that has been found. There's been authors who have provided proofs of how you do that, right? In a few different ways. One of the issues, I think, can be that those proofs are perhaps complicated, right? So if somebody's saying, oh, I want to know that this is fair, and you show them a paper that's 40 pages long and full of math, right? They're not going to understand that, or even believe it necessarily, right? If they don't understand it, they don't want to believe it. So we have to come up with a better way. So one of the things that I've been working on, and other associates that I work with are working on, is how do we do this fairly, or at least equitably, right? Very, very much fair, such that maybe not 100% mathematically spot on, but any bias is so negligible that no one will even notice, right? It's like a penny on $1,000 or something like that, or $100,000. And there's ways to do that. You can think of, like, one example would be, we can say, oh, well, I know in advance what, from mortality tables, what your expected risk of dying was. So that's like the expected longevity credits you're going to receive. Now, at the end of the period, we're going to figure out, okay, who did die? Let's add up all the balances of those who died. Let's show it to everybody very transparently, right? It was so much money. Now we're going to segment that up and figure out who gets their share, right? And the idea would be something like, okay, you should get what you expected, right? What we thought the mortality credit, longevity credit would have been based on expected mortality rates. And then we could say, oh, well, the number of people who died wasn't, or the amount forfeited wasn't exactly what we thought. It was maybe 0.5% higher, or 0.75% lower, or something like that. And then say, okay, everyone's going to get, 0.5% more than they expected, or 0.75% less than they expected. And that result comes out to be extremely close to the pure 100% actuarially fair result, such that any bias is so negligible no one will know. And it's very understandable, right? You could say, oh, and readily perceived as fair, right? Everybody gets an extra 0.5% this month, right? Or year.
Yeah, thank you, Rich. And I think the way I would summarize what you're saying is that it has to be explainable, and it has to be perceived as fair, and it should be satisfying. You should do it good enough, because the real win is that you can pool your longevity in the first place. And then if it's acceptable fair, you probably are close to a winning recipe. Right. I would like to jump into another topic now, because one thing which is very popular in the UK today, and I think also across the world, is how do you create a product that is sort of offering this? And one formula is the CDC, which some people say stand for collective DC, and I say it stands for complicated DC. But what they've done is we've taken sort of the administration of a defined benefit scheme, take away the guarantee and make the benefits variable, and then you run it in a very complicated matter, keeping track of everything. The Dutch basically abandoned this, but in the UK, one of the CDC legislation coming in is being based on this model. But instead of commenting on that, because a lot of people have done that, I would say, let's now play with the idea that we are a master trust, which is basically a DC scheme, which is run by trustees are there to make sure that the members are treated fairly. But it's a standard DC scheme that also can do drawdown or payout solutions. So assuming that we're sitting in there and trying to figuring out how can we do this in a practical way and put on our sort of problem solving mode, I would think, assuming that all the regulatory stuff is sorted, can you then mix sort of different type of annuity or lifelong payments? Could you, for example, put in a immediate lifelong payment starting the day you retire? And some people say, no, I don't want that. I want sort of a lifelong income starting at age 85. Can you mix that with this sort of approach you're talking about?
Yeah, I think the answer is absolutely yes, right? And that's the beauty of kind of this unbundled approach. So if I can just like step back for a minute and just look at kind of the CDC idea, right? It just sounds so much like this kind of taunting principle that we're talking about. It's risk sharing, right? And yet there's like fundamental differences here that we're talking about. And you know, one isn't necessarily better than the other. They're different, I would say, right? There's advantages to each. And I think that the taunting version has some compelling advantages that people should seriously think about. But the like collective defined contribution, you know, has this idea of there's a target that benefit they're trying to reach, right? And you can see that this was kind of invented, I guess, by like defined benefit experts, right? It's like, well, let's try to make it look like defined benefit as much as we can without having it be guaranteed, right? Which seems like a wonderful thing. But you run into some issues, right? Because you have to make a lot of assumptions, like super long-term assumptions. How confident are we that we're going to meet the target benefit, right? So the other way to look at it, instead of like kind of a DC context, or instead of a DB context, is just to say that, you know what, we're not going to pretend that there's liabilities or a target. We're just going to say, I have a pool of assets. I'm going to accumulate it as efficiently as possible, right? And that's kind of what I'm talking about. And so, you know, I think in the context of like a master trust scheme, you can create a pool that is operating with a number of different employers in it, right? And everyone who's participating in it, all their longevity risk can be pooled together. It's completely separate and unbundled from everything else, right? So as someone dies, then we say, oh, okay, they have this balance. I'm going to take it and I'm going to redistribute it to all the other people who are still alive. And that can be done pretty simply, right? And passively, I would say too. It's like by formula, right? So it doesn't have to cost a lot of money. This could be done very inexpensively. You don't really need a lot of actuaries to run it. You just need to say, determine what the mortality rates, expected mortality rates are, and then let the sharing happen within the pool.
Well, then, so that's a good thing. So you can have deferred annuity if people want that. You can have an immediate annuity kind of replicator if you want that. Sorry for using the A word, by the way. But the other alternative, you can then to sort of play on this idea. So since I separate it, it means I can have different investment profiles as well. So some people might like a more safe retirement like Svi Bodhi, and some might be willing to take a bit more risk like Don Ezra in the previous webinars. So they can have the different investment approaches and still pool their individual longevity.
That's exactly right. Yeah. So everyone can say, oh, I'm going to take my own payout choice. Like some people might say, like you say, I want the immediate life annuity. Some might say, oh, I'm going to want mine to be deferred to age 85 or something. So I just want to pool the tail risk. And similarly on the investment side, right? So if the master trust offers 10 different investments, people can choose which investment they want. Right, and it won't affect the longevity risk pooling at all. Everyone will still get the longevity credits that they expect, the fair amount, but they can make their own decisions for the investment. And that's really, I think, the power and the beauty of separating and unbundling the risk pooling element from everything else.
So basically, the main difference between a sort of drawdown account where you have no longevity pooling, and a lifelong income would be a tick box at the side of when you've chosen your investment risk level. You say, do I want it lifelong or not? Like a tick box. Is that how you envision it?
Yeah, that's right. And you know, some people might say, oh, I just want this to be kind of a bridge strategy. I have my Social Security starts at age 70 and I'm retiring at 65. So I just want like a 5-year, give me a 5-year risk pool, right? You pay me out for 5 years and I'll collect longevity credits along the way. And then at the end of the 5 years, I don't need any more. So I start collecting my Social Security. There's lots of different ways people could choose to do this.
One reason why people are not willing to pool their longevity is it's kind of presented as a Hotel California. Once you've done it, you cannot go back from it. What is your way of addressing that concern that people have?
Good question. So in the ideal sense of these kind of arrangements, I think at least one way to look at it from an economist's viewpoint would be that it should be irrevocable, such that it is kind of what you just said, right? So you put your money in, and the reason is that maximizes the longevity credits that you're going to receive, right? So people can't just pull their money out, right? They get their lifetime income, but if they decide to pull out early, they can't, right? That maximizes longevity credit, the benefit to the survivors. Now, we know that that isn't the only consideration for people, right? People worry about, like, oh, it's locked up, right? I can't change my mind later. And people like to be able to change their mind later. So I think there's two ways to go about that. One is just to say, well, don't put all of your eggs in this basket, right? Put a portion in, and then you have liquid assets to use on the side that in case you need it. But the other is to say that, well, there's really no particular reason that these arrangements have to be irrevocable, right? If we just say, and in fact, you see the longevity fund offered in Canada and in Q Super, right? They've added these kind of features where you can be sure you get your initial money back. So there are ways to do that. Now, it's a trade-off because you're going to get less income out of it because you're not going to get as much longevity credit if people pull their money out. But that might be an acceptable trade-off to people, right? It's like, oh, I want liquidity, so I'm going to accept the trade-off that I won't get as much income. And that's certainly possible.
I remember from the discussion with Brennick van Wyk, he basically said that this was a commercial consideration to put this in, otherwise they would not be able to sell the product. So there is also that dimension to it.
Yeah, that's right. Now, personally, I would love to see someone put something in that is irrevocable, just so that we can find out, is that true, right? Would people not buy it? Because I think there could be demand for, like, give me the most money I can get, right? Who wouldn't want that, right? Even if I put only 10% in, I can maximize my income. But until someone does it, it's hard to know.
I think that's a very good point for us to sort of open up the floor. And from what I've heard from you today, you could say if you do have a decent master trust of decent size, you can actually do this as an overlay on top of your existing machine. So you have your investment structure for drawdowns, and you can recycle that and you put this around it. So you can actually quite easily, technically, create a lifelong income for those who want. And you can also, if not too many want it, you can probably still do it because it's a very small cost of doing the pooling this way. So let's see what people ask you, what kind of questions they have. And I have one question from Adrian Balding. He couldn't come today, so I promised him to ask you that one. And he said, what happened when you have this kind of arrangement? And for master trusts in the UK, you have a sort of, in the regulation, you need to have an orderly way of winding down if there's kind of too few members or the business isn't sort of sustaining itself. How would you do that when you have a sort of longevity pooling arrangement around it?
Yeah, that's a great question. So we get into all these the little questions that are so big, right? What if? At some point, I think there would be embedded into the documents that create the structure that would say something like contingent events, right? That would say we wind this up basically, so that if a certain event happens, then we say we just take the balances that are in existing accounts and we give them back to their owners.
Yeah.
It would just be done on, so everything is counted for at an individual level here that I'm talking about, right? So it's like your money, right? So that if an employer decides they're going to wind down or for whatever reason, then we just say, okay, your balance is yours. Here it is, right? You can reinvest it in some other vehicle outside of the taunting.
I think that explains it in a good way, because the big discussion in Netherlands when they want to wind down the old system is actually who owns what and how you're going to redistribute it. And if you already know that, it's quite straightforward.
Yeah.
I have a question from Andrew Young, and he says, is it correct that the longer you live, the more resources you need? You said that very early on, I think, in the conversation. Is this US/healthcare specific?
I'm wondering what terms he's talking about, right? So I'm trying to figure out how to answer that. So I think one way that he might be thinking about it is that some people might be of better health than others. And so there's kind of an adverse selection going on here, like there is with annuities, same kind of thing, right? So if you're healthy, you're more likely to opt into this. If you're not healthy, you're less likely to opt into it. Another way, which is true, right? And I think as designing these products, we say, oh, there's going to be some adverse selection, so we're going to build that into the mortality rates, right? Same thing happens in the insurance industry. The other way to think about it would be something like with long-term care, right? Who knows who's going to need long-term care, but if you do, it could be very expensive. And that's true, right? So long-term care is something that's notoriously difficult to insure. And we've had discussions with some insurance consultants about the idea of having like a long-term care taunting arrangements that could provide for that kind of benefit through a risk-sharing structure. I would think that's separate than a traditional pension, but possible.
Another question from Catherine Donnelly. Richard, what is the purpose of your proposed fund? Is it to pay an income or give longevity returns? If you want to pay an income, can you really allow everyone to invest as they like? And she has a follow-up question here as well. Richard, how do you deal with the end of fund longevity risk? No fund will last forever. I think we covered that one already. So take the first one.
Okay, yeah. So Catherine is an expert in this and is one of the people who have done the actuarial work to show, to demonstrate fairness, like pure fairness, how can this be done? So let's see. There's a lot there. So the first part of her question had to do with, was it
what's the purpose of your proposed fund? Is it to pay an income or give longevity returns?
Yeah.
And if you want to pay an income, can you really allow everyone to invest the way they like?
Okay, yeah. So I would say, like, I tend to think of it as the income being the objective. Now, it doesn't have to be that way necessarily. You could have designed a taunting scheme that says, I'm going to pay a lump sum after 10 years, and then it's marketed to people who want the longevity returns, right? I'm thinking more in terms of a pension where people are wanting lifetime income, right? So it's the income that really matters. And it's nice that you get the longevity return as well, because then you get more income, but it's really about the income. I mean, I think Catherine has papers herself about showing how this could be provided in a way such that people can make different investment decisions and have it still be fair, right? So the expected outcome is going to be the same regardless of what their investment choices are. Now, the important thing, I think, is that if someone says, oh, I'm going to buy into this and invest in all stocks, right, 100% stock, their income is going to be extremely variable, right? Because the volatility flows straight through to the payout. Now, if you don't want that much variability, then you add more conservative investments, and then it's a problem of determining, well, what should the asset allocation be?
So, Richard, because you can separate financial risk from longevity risk, your income stability going to be derived from your investment risk profile, right? That's sort of the strength of it. Right. So it gives you freedom.
Yeah.
David Gullard, he has a question. Have you examined the MGM Advantage flexible income annuity that attempted to address this, but designed for the then UK regulatory regime?
Interesting. No, I have not. I'm not familiar with that.
Okay. So let's skip to the next one then, because it says from David Bird. Richard, for the UK, what, if anything, is standing in the way of this payout solution being offered?
That's a good question. So a couple things, I guess. One is, I guess, regulation. And not only regulation, but I say perceptions about regulation. So like in the US, for example, if I ask 100 different people in the investment or insurance industry, can I do this today, right? Most of them would probably say, no, of course not. Tauntings were banned in 1906. Right? And then I come back to them and say, really, show me, right? And it's not true, right? There are examples in the US, TIAA, for example, has billions of dollars they're running in this kind of arrangement, right? But there's a perception, right? So we got to get beyond the perception that, no, this is perfectly legal, right? Just you have to, which is not to say that you don't have to get permission still. You still need permission from the regulator, but and the UK, I'm not as familiar with, but the regulation is a big issue. Now there's the Pan-European Personal Pension Regulation and the EU. There's Solvency II that allows for taunting products already. So I would say it's something that if somebody wanted to offer this, right, there's certainly avenues for them to be able to do that.
There was a comment here from Dean Mcclellan. He says, nothing one CDC are allowed. And if you think about the fairness described in the sort of current Royal Mail version of flavor of CDC, I think you offer something which is much more precise.
Right. So Dean, another proponent of tauntings and developing them for the Pan-European personal pension market. Yeah, it's true, right? So as I say, there's benefits and drawbacks of CDCs. One of the issues is the kind of the perception of bias, since there's intergenerational risk transfers going on in these kind of arrangements. And you don't get that with kind of the pure taunting risk pooling approach. So I think, and the fact that, like you say, it's much less complicated, right? We're just going to pool the risk, and we're not going to have all the other components going on with all the other assumptions about how people get payouts.
A question from Theo Kokken in Netherlands. Are there regulatory hurdles, UK, US, etc., that reduces the probability of success of this very effective approach towards old age micro longevity risk sharing?
Well, maybe you can help me with that, Stefan, since I'm not quite so familiar with the UK regulatory market.
But you could say, from your experience, what you have been working with, have you come across places where this is sort of not possible to do? Or is it sort of, or do you need some big regulatory overhaul to actually make it happen?
I don't think you need a big regulatory overhaul to make it happen. And I just kind of point to to companies that are doing it today, right? In places where I've always heard people say, oh, you can't do it. So Australia, right? People that I've talked to there for many years have said, oh, you can't do that. Well, Q Super just comes along and does it, right? Canada, the purpose investments, they just decided to do it and they did it. There was a company in the US that filed for a mutual fund that has longevity risk pooling in it. They just do it, right? And you work with the regulator, and the regulator says what's going on here, and you show them, and then show them that, yes, we're doing this fairly. And the regulators think this is a good thing. So we're seeing this in many countries, right? That there isn't really a big hurdle. Now, that's not to say every country would be that way, but
at least you're optimistic that it can be implemented, and maybe people just haven't tested the boundaries yet.
Yeah, that's right. Yeah.
Catherine Donnelly comes back with another one here.
Super.
She says, I disagree that CDC are different to tontings/pooled annuity funds. You could run a pooled annuity fund as a post-retirement CDC with a goal of providing a retirement income rather than just giving longevity returns and asking the members to figure out how to decumulate.
Yeah, I guess it depends on how one's definition of CDC, I suppose. I certainly see these as very similar, but you could call them the same thing. I guess the way I think about them is different, would be that CDC tends to have a notion of sharing the investment risk as well. Whereas what I call the pure tontine, that doesn't happen. Everyone gets their own investment risk, and all they're doing is sharing the longevity component of it.
If I would comment on that, I think the advantage with of separating the two is actually, if you want to have a stable income for life, you can have an investment strategy that is very stable over a long time period. And by doing that, with the pooling of the biometric risk, you can actually have a stable income for people. It's a bit of a variable annuity design rather than working with guarantees. But of course, you can work with guarantees as well if you want it. Because you separate the two, you have the freedom of playing it. And I think, as you're fully right, you're saying that the CDC we've seen in the past, it's a package deal. It's this investment approach, and this is the longevity. So for each kind of flavor, you need a new sort of fund, which makes it very difficult if you're going to have many different flavors to get them big enough so it's actually commercially viable. So I think theoretically it shouldn't be a big difference. And I think the good news is, if there isn't, you can get what you want to get with CDC in a much, much simpler way.
Yeah, I would say that. And so, I mean, there are some advantages to packaging, I suppose, but it does reduce the flexibility, right? So that people can't make their own choice about, crafting the payout that works best for them.
So we have a question from JQ. He says, Andrews Young's question is fundamental to the UK. The foundation of which economic versus true utility value needs as people age. Solutions can be ideologically and demonstratably fair, but if they are paying out greater value when it isn't needed, are they really just, question mark? I couldn't make. So JQ, if you put kind of a clarification at the end and a new one in, we can get back to that one.
Okay.
Bernard Casey had a question here. Are there correlations between investment decisions and longevity? And if so, what is to be done? So he basically challenged the assumption, are they really independent of each other? Yeah,
sure. So I guess you could think of something like, I don't know if this is what he's thinking, but you have like the stock market crash of 1929, where suicide rates went up because people were suddenly devastated financially. So from that perspective, there can be some correlation between mortality and investment return. And in that case, I hate to talk about it this way, but it's actually kind of favorable to the taunting buyer because your longevity credits would go up in that case, right? Assuming you aren't one of the people that committed suicide. But generally, I think we can say that they're very uncorrelated. That's very few times in history does that happen at scale. So I'm not sure if that's kind of what he was talking about or not, but I mean, we can show that your expected value of your longevity credits is independent of people's investment decisions, and I mean, I can point to papers that show this.
Ed Collins have a question. With full freedom on withdrawal patterns, how do you avoid selection risk, i.e. deathbed withdrawals, which would lead to limited longevity credits actually emerging? So basically, if you allow people to leave, how do you make sure that you don't get a lot of sort of adverse selection?
Yeah, I mean, I think that is the issue with allowing people to leave, right? So you might, a plan might want to allow that because they think that's people's preferences, but it's really not ideal in terms of getting higher incomes. So you may not want to allow that either. So, I would think, there could be some ways to deal with this, such as saying, well, you can't withdraw 100% of your money at any given time, but maybe 5% or a year or 10% a year or something like that, to say, oh, at least some partial liquidity. If I need to get the roof fixed, I have money to do that that's available to me. And again, I wouldn't suspect anyone would want to put 100% of their money into anything like this, but to the extent that that's a behavioral preference that people want, you could at least provide, a partial withdrawal options without full withdrawal option.
Catherine comes with more questions here. He says, also have results on the income paid from such pooled annuity funds under stochastic mortality model to be presented here. So she shows us a link in the
paper. Yeah.
Your paper. But I don't have papers on providing an income and allowing different investment strategies. So she says that's an area of future research.
Okay.
And she says, I don't think it's true that there is no intergenerational issues with pooled annuity funds. What about systemic longevity risk?
In terms of, well, with these kind of pure longevity risk sharing arrangements, the individuals are sharing that risk, right? Yeah. The idiosyncratic risk is diversified away, and the residual, including the systemic, is shared by people. And there's also the notion that longevity risk changes over time, right? So we expect mortality improvement to occur. So typically what we would do is to build that longevity improvement into all the mortality projections.
And you're saying it's not the long systemic error here because you do sort of realize mortality every year and redistribute it, and then you sort of start from scratch. So if there's a difference in your model and reality, it will sort of be settled every year. Is that how I should view it?
Yeah, I think so. So, and I have a paper with Mike Sabin, we call it individual taunting accounts, that kind of show this. And we basically set it up that we're going to have a pool with people making their own payout decisions, making their own investment decisions, and showing that the payout and the longevity credits are independent of the decisions people are making, right? So kind of start this, like some people are investing in stocks, some in bonds, and then we say, well, what if almost everybody is investing in one, and very few are investing in the other, right? Most people are in bonds and fewer in stocks, or vice versa, and you get the same you get the same result essentially in terms of the expected payout.
We have a question here from David Gullard. Have you done some modeling on minimum size, number of members, size of assets before you get acceptably stable outcomes? And how do you have the seed capital? I think this is a very practical and good question.
Yeah.
So we'd love to hear, how big do the pool need to be?
Yeah, good question. A lot of people have done this kind of work, Catherine included, Moshe Milevsky and others. And I suppose you get different answers depending on how stable you think the credit should be, right? So I think generally, it's the law of large numbers, right? So bigger is always better. By the time you get to say 500 people or so, you've diversified away most of it. I think I've heard Moshe Milevsky say 500 people seems like enough. I tend to say 1,000, but it's kind of a marginal gains, right? Every time you add another person, you get benefit, but a little bit less than the time before. And others might say, no, it needs to be higher because, but it's pretty easy to show. And there have been papers that have shown this.
I think another part of his question is basically, how do you make it commercially viable for someone in terms of how do you get going from start, so to say, the seed capital?
Oh, yeah, the seed capital. Well, yeah, that's a good question. I'm not sure how companies have done that, who have launched, right? That'd be a good question for the Q Supers of the world and others who have launched these kind of things. So in some cases, if it's done more like a mutual fund arrangement, I think, typically the company will put up the original seed capital. But then they have the issue of, well, if you don't allow the people to get their money out, how does that happen? And presumably there would be a provision in there that would say, after the scale is a certain size, at least the initial seed capital comes out. So that could just be done by governance.
And if you are a master trust or something like a pension fund like the Q Super, you do have a lot of assets under management already. So you have the economies of scale. And if this product is done as an overlay on an existing portfolio, you don't need a lot of capital to get it going.
You don't need a lot of capital to get it going. That's right. You need a lot of people to buy into it in order to get the diversification that you want, right? But you don't need a lot of capital to get it going. That's true.
Sam Underhill has a question here. Who is best placed to drive the development of these types of products? Academics, governments, employers, or product providers?
Or all of the above, perhaps. In addition to the research company that you mentioned earlier that I work with, Nuovalo Ltd, we've also launched a new company now called Nuovalo that's developing kind of this unbundled longevity risk pooling architecture. And the idea is it just does the risk pooling. It doesn't try to do anything else. And the idea is it can be snapped into like a record keeping system that a provider has and just doing the pooling aspect of it. So can you tell me his question one more time?
Well, he says, who is best placed to drive the development of these type of products? So,
right, yeah. One of the things we've done a lot of work on is working with regulators in various countries, particularly countries that really realize they have a pension problem, right? So the regulator is driving innovation because they realize the government is kind of the last stop, right? If people go broke, it's going to be the government that has to step in, and they want to avoid that. So I think regulators are one point for sure, and then the other would be, presumably it's going to be like investment managers or insurance companies or anyone providing these kind of pensions to people to say, hey, we can do this another way. You see Q Super like one example, right? We can innovate.
And I think my comment would be, I think you need everybody to get it going. It's good if academics look at this and say, does it work or not? Governments need to enable it. And I think both product providers and employers selecting product providers should sort of look at this and think about it.
Yeah.
There was a question from Andrew Young. I think that's going to be the last question. He says, can I check on how these tontines work? Is an expected level of death assumed from start and throughout? So the longevity credits are only the difference between actual experience and assumed, and perhaps small. or are there no death assumed, so that in effect it is an individual expects their income to increase over time due to longevity sharing, and if you survive, will increase rapidly at older ages?
Yeah, good question. So, I mean, I see this as something that should be very transparent, and that's not always the case in these kind of solutions, but ideally they would be, right? So you can see exactly, like, we expected this much in terms of longevity credits to reallocate. Well, actually it was different. As I said before, it could be somewhat higher or somewhat lower. And to just show simply, like, this is how much we expected, this is how much actually was the balance remaining of those who did not survive this period. And then we could say, okay, now we're going to reallocate it based on this formula, and you can see how everyone gets their share that was determined. But I think maybe embedded in that question as well was this idea that perhaps should the payouts be made, like, assuming there are going to be deaths and longevity credits? And I think the answer there is, yeah, sure, right? So we can say, today, I think, for a given investment and contribution amount, that, it's maybe €1,000 payment for the rest of your life. Now that's going to go up and down with experience, right? But I can expect there's going to be a certain amount of investment returns, and I can expect that some people are going to die, and I'm going to be able to redistribute those assets. And so I'm going to make today's payment based on those future expectations. And this is one big difference between DB plans. I mean, DB plans do the same thing, right? But they're basically on the hook for the assumptions. Whereas in this arrangement, we just say, well, that's what I expected, but people are dying slower than expected. And so therefore the payout is adjusting gradually over time.
So Richard, now you have answered a lot of questions. It's time for you to ask a question. So this could be a question to our next speaker, which is Anna Maria Lusardi. And she will come and talk to us on March the 3rd on the topic of financial literacy and financial well-being. So what is a question you would like to ask to Anna Maria?
Well, let's see. Yeah, so she's an expert in financial literacy, right? And I'm a big believer in promoting financial literacy. Now, on the other hand, I think many people express concern that giving people more choices, such as I'm suggesting here, right, can lead them to bad decision-making, right? It's already a complicated process of determining what should I invest in, how much should I allocate to this or that. That's a challenge even for experts, right? And there's a lot of differences of opinion among experts as well. So, I think longevity risk pooling is a very, very good thing, right? But as we introduce yet another option for people, we have to think about that, right? So my question for her, I guess, is like, as these solutions become introduced into DC plans, and as I say, they're starting to now, right? But how can we use financial literacy to nudge people into decisions that are best for them without really trying to add to their complexity and make the choice harder, right? So how can financial literacy help us in that endeavor?
Thank you, Richard. I would like to say a big thank you for coming here and sharing your thoughts around this. It's been very enlightening for me, and I think it's been very enlightening for everybody in the audience. So I would like also to thank everyone in the audience for your good questions. And this is something we need to think about. And I think there's something in here where we can actually make something good for people to get a lifelong retirement income without being so complicated. So perhaps we should call it Simple DC. With that, I would like to say thank you and hope to see you again.